All right, guys, welcome to today's session. We're going to be looking at generating consistent income with options. So hope everyone's having a good week. Obviously, markets are pretty crazy, so we'll talk about that a little bit as well. Just a reminder that anything discussed today is for educational purposes only and shouldn't be considered investment advice or a trade recommendation. Make sure you check out the disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. All right, so before we go into the outline, I just wanted to talk briefly about what's happened in the markets in the last couple of days. Obviously, some really big moves, so important that we kind of talk about that. And one really important concept that I want to share with you guys, again, this is all available for free. VIXCentral.com is the website. So this shows us what I'll call the VIX futures curve. So it tells us what the VIX level is out through time, right? So yes, I am recording it, Chris. Yeah. So obviously the closest one would be the spot VIX. What is the VIX at today? This is actually a historical one that we're looking at, which I'll explain in a second. And based on the option prices, what do traders think the VIX is going to be further out in time, etc. Usually it's sloping upwards and to the right, as you can see with that green line. That's a standard scenario called contango. And the opposite scenario is backwardation, where we've got high prices at the front of the curve and lower prices at the back of the curve. I won't go into it in too much detail what those terms mean, but basically, when the market's in a normal situation, we'll be in this contango situation. The VIX is low at the front and higher at the back because traders want to be compensated for the fact that something could happen down the line, right? Whereas when we get into a market panic, as we did on February 5th, 2018, this is when the VIX jumped about 115%, the volpocalypse, as they call it. A couple of hedge funds blew up, all that sort of stuff. Volatility in the front part of the curve went nuts, but it didn't rise as much at the back part of the curve. So in backwardation, the expectation is, yes, we're going through a little bit of a market panic right now, but in a couple of months, things are going to settle down a bit. So the back part of the curve isn't affected nearly as much. So you can see the spot VIX went from, let's say, about 13 up to about 34 over the course of a couple of days. Whereas, when we're out sort of 90 to 120 days out in the curve, it's only gone from sort of 15 to 20. So on a percentage basis, that's much less, from 15 to 20. Very, very low percentage compared to 13 going to 34, right? And this is one of the reasons I think I talked last week about trading longer term options. When you get a VIX spike like this, all options are going to behave like this, right? The longer term options aren't affected by that volatility spike nearly as much. So it's a really important concept, and one of the key reasons why I sort of trade now out on this 90 to 150 days out on the curve, right? Even out to sort of 180 days sometimes. Anyone trading weekly or even monthly options here would have got absolutely crushed by a move like this, right, on the 5th of Feb. Similar to the move we saw in the last couple of days, there's been a very big spike. The VIX did spike over 100%, not in one day, but over the course of 2 or 3 days. So obviously the front month of all options has been seriously affected. Anyone trading weekly or monthly condors has been absolutely killed. People trading out here on this part of the curve like me, yeah, taking a bit of losses on our condors, but no major damage, right? So that's a really, really important concept that I wanted to share with you guys. Brief overview, obviously there's a lot more detail we could go into on that, but just a pretty important concept to be aware of. All right, so what's the plan for today? We're going to talk about using probabilities in your favor, one of the key methods for trading options. Talk about trading delta neutral, what that means and how we do it. We'll talk about consistency and why that's really important, and how we can enter our trades with consistency. Talk about only trading highly liquid stocks and ETFs, and we'll touch on strategy selection and portfolio management, which is obviously another really important concept. We could spend 2 or 3 sessions just on portfolio management. We'll touch on that briefly today. All right, so the important thing is with options trading is to keep it pretty simple. And as Einstein said, everything should be made as simple as possible, but not simpler. So you really don't want to try to overcomplicate things. Sometimes when you start learning more and more about options, you start doing these fancy strategies and things like that, but sometimes it's best to just keep it really simple. So one of the ways we can do that is by using probability, and using them in your favor is the best method for options trading success. You should aim to generate consistent income rather than looking for home runs via out of the money options. It's always, people get sucked in thinking, oh, I can buy this option for $50 and it might go up to 1,000 or something like that, but it very rarely happens. The better way is to try to trade consistently and hit singles rather than home runs. Typically, broad markets trade in a sideways manner the majority of the time, and it's been said that 80% of options expire worthless. So would you want to be a buyer of options? Of course not. We want to be selling options because there's something called the volatility risk premium, and we want to be taking advantage of that by selling options. Market makers know that buying out of the money options is a fool's game, so they tend to trade from the sell side. Okay, that's how the market makers do it. And why? Why do they do that? Well, it's all based on probabilities, but don't worry, you don't need to be a math geek. Market makers use mathematical models to determine the price of an option, and knowing the likelihood of a stock reaching a certain point allows them to set a price based on that probability. So you might have seen this chart before, what's called a normal distribution or a bell curve. Sort of tells us that the majority of the time, stocks are going to stay within this one standard deviation range up or down, about 68% of the time. And then about 95% of the time, it's going to be in a 2 standard deviation range up or down. Okay, so very important concept. Now, financial markets, unfortunately, never behave exactly like this. It's like a normal distribution. They have what's called fat tails. So occasionally we do get these 3 standard deviation moves, and we need to be aware of that and allow for that within our trading by things that we talked about last week, out of the money butterflies and things like that can help protect us a little bit. Okay, so using probability analysis gives traders a very useful tool for determining price targets to trade against, and they are free on most platforms. You can also use delta as a quick estimate. Okay, so using delta as an estimate for probability, I'll explain that on this slide here. So here we've got some SPY options. We've got highlighted here on the call side, September options, a 312 call, and it's got a delta of 0.11. We'd call that the 11 delta calls. It's not perfect, but we can say that roughly speaking, we've got an 11% chance that the S&P 500 is going to hit 312 by expiry, okay? And on the downside, 275 on the puts. We've got the 14 delta puts. Got a roughly 14% chance that those are going to get hit before expiry. Okay, so that's sort of the rough level where I like to trade. About 14, 15 on the puts and about 10 or 11 on the calls. And the reason is why that's different on the puts and the calls is because of something called volatility skew. So the volatility on the puts is usually a lot higher because the markets have the tendency to crash down rather than crash up. So to keep delta neutral, we actually have to trade, slightly skewed trade. And I'll talk about that. Doing unbalanced iron condors is something that I do a lot, where you're actually trading, less calls, than puts. Okay, so that's our delta, and you can see that that's a pretty true relationship, because if you look at the at the money options, we haven't got them here, but at the money options are going to have a roughly 50%, a 50 delta, right? And what we do is, if we double that, is the chance of it being touched during the life of expiry. So it's basically got a 100% chance of being touched and a 50% chance of finishing above or below. So obviously the 50 calls have got a 50% chance and the at the money puts have got a 50% chance, right? It's either going to be above or below where it started. So we can again say that with these 11 delta calls, it's got an 11% chance of breaching that level at expiry. If we double it, it's got about a 22% chance of being touched at some point during the trade. Okay. So hopefully you've learned something there about delta and probabilities. So trading directionally is difficult enough, but with options, you also need to be spot on with your timing. So you're gonna be right with your direction and your timing because of time decay, right? Volatility also plays a part. And you've got to be right on volatility. You could be right on direction, you could be right on your time, but if volatility drops, you're still not making money on those directional long option trades. The easier, more productive way to trade is delta neutral. And as I said, that's the approach that professional traders and market makers take. All right, so here we have an unbalanced iron condor that is no longer delta neutral. Okay, so here I was talking about a few minutes ago, trading more puts than calls. So this position would have started off as delta neutral, and we would have been probably around 13, 14, 15 on the negative delta puts, short puts, and on the short calls we would have been about delta 10. So the market's rallied since we put the trade on, and we've now got an unbalanced condor. You can see our delta here is 23 negative. So the market's gone up, giving us negative delta. We want it to go back down to get back into the middle of our condor. And we've got delta dollars of 31,000 as well. So delta dollars is another important concept that I'll touch on briefly here. And this is basically our dollar exposure to the underlying. So with this condor, the 4 options that we've got here, the 4 strikes and this number of contracts, it's the equivalent of having a short position in the index to the tune of $31,500. Okay, so if you've got an account size that's only $10,000, this position is way too big. Okay, and I've got lots of rules around delta exposure and delta dollars exposure that we want to let our portfolio get to before we want to adjust, right? So if your portfolio is $10,000, you've got an exposure of $30,000, way too big, right? But if your portfolio is 100,000 and you've got a position like this, your delta dollars is 31,000, it's not too bad, right? It's 31% of your portfolio is taking a directional bet on the downside. Now that's about the limit that I'd want to get it to. So as I said here, it's no longer delta neutral, this position, and probably look to adjust here and bring that delta down a little bit. Okay, give it less negative delta. So we want to be getting back to delta neutral by either adjusting these strikes or adding new positions that have positive delta to help offset our exposure on this position. Oh, and just one more point on delta dollars. Question that comes up a lot, how's that calculated? Basically, we take our overall position delta of negative 23 and we multiply it by the underlying price. So if you have Excel or a calculator, 23 times 1396 is going to give you 31,538. Okay, so you can do that with any underlying. Interactive Brokers gives us this column in Risk Navigator, which is quite handy. I think some of the other brokers have it as well. Thinkorswim, they call it something different, like delta notional or something like that. But you can very easily calculate that in Excel pretty quickly as well, right? Just take delta times price. All right, so that's our position before adjusting. We've got the 1260, 1240 puts and the 1460, 1480 puts, calls, sorry. So here's our adjusted position, and I'll explain the rationale with this. So by leaving the calls alone and rolling up the puts, we've made the position delta neutral once again, more or less, right? We've got a little bit of positive delta, but that's fine. The reason we didn't move the calls in this case is because we're okay with that delta of 13 on those short calls. We're comfortable leaving them there. If that was up at around, say, delta 25 on those short calls, I'd be looking to take some defensive action and roll those out, right? But I'm pretty happy with where they are. The market's at 1396. We've got 65 points before those get touched. That delta exposure on those calls is fine. So having a delta of 5 on the puts was very low. So the right course of action in this case was to roll these up to that sort of standard, 14, 15 delta that we look for on the short puts. So by doing that, we've done 2 things, right? We've helped our position get back to delta neutral, and we've also brought in some extra income, right? So let's just do some quick calcs here. Let me get Excel up. So if we've got 10 contracts here, so we've got 534 that we're selling and we're buying them at 385. So that's $1.49 times 10 contracts. Okay, so we've brought in $14.90 in premium for selling this spread. Now if we go back, we had to buy this, oops, sorry. Oh, this mouse is a bit sensitive. All right, so we had to also buy back the 1260, 1240s. So that's 212, 162. So that spreads at 50 cents. So that's cost us $500 to buy back. And we sold the new spread at $14.90. We've basically brought in just under $1,000 in premium, all right? So by doing that adjustment, once again, two advantages. We've neutralized our delta and we've brought in some more premium. We've added more profit potential into the trade. Okay, we've added a little bit more risk to the trade because we're now a lot closer with our puts and our position's a lot narrower than it was. But all of our risk parameters are fine. We're pretty much delta neutral. We're happy with the short delta on the puts. We're happy with the short delta on the calls. All our ratios look good. Our delta to theta ratio is very low. Our vega to theta ratio is low as well. We're happy with that, all right? Okay, any questions before we go on? All right. Good, good. All right, so a good rule of thumb is to keep delta to less than 20% of theta. Okay, that's what I'm talking about, that delta to theta ratio. This makes sense for the Russell, which is kind of the main instrument that we trade, but it doesn't work for every instrument, okay? And I'll show you. So this trade looks good. Delta is less than 4% of theta. Vega is only 250% of theta, so nice looking Greeks, right? Delta theta ratio is good. Vega theta ratio is really good. You know, our actual delta and delta dollars is really good. I haven't got the delta of the individual strikes, but that looks good as well. 10 contracts here, so 16 and 10 delta. We've got a balanced condor here. 10 contracts on the puts, 10 on the calls. Notice how we have a little bit of negative delta, even though we're balanced. And we're trading, that's why we're trading the 16 delta puts and the 10 delta calls, right? Okay, so those ratios look good, 4% and 250. So let's compare that Russell trade with an iron condor on IWM. Notice that the trade is pretty neutral. See that delta dollars is actually less than the previous one, so our dollar exposure is much lower. But the delta theta ratio is at 30%, much higher than in the Russell. And why the difference? Well, it's because the price of the underlying is a lot lower. Okay, so we have to adjust our delta theta ratios, or we have to trade based on our delta dollars. Okay, so the key is to normalize by using delta dollars. So we want to keep an eye on our delta dollars figure, and we want to create rules around that in terms of what exposure level we're happy for that to get to before we adjust. So if we keep our normalized delta theta ratio below 20 to 25%, we'll hold you in good stead and help prevent big losses. Once that ratio gets above those levels, losses can accelerate really, really quickly if the market continues to move against you. Okay, so that's why it's really important to set those levels. What delta are you willing to accept? So, you know, take the last few days, for example, we've been dropping pretty steadily. Other than today was a bit better, but you know, after a couple of days of declines, a lot of these condors would have a lot of positive delta, right? And you know, maybe they're still within their exposure levels, maybe they're not. But if you don't have exposure levels, you're just sitting there hoping for the market to bounce back. But if we have very specific exposure levels, we know when we need to adjust, we know when we need to reduce that positive delta that we're picking up. If the market continues to decline, well, we're much better off because we've gone back to delta neutral, right? Than someone who just leaves their position and just holds and hopes, right? And as they say, hope is a shitty hedge. All right, one other point on delta dollars, which I'll make on this next slide. Before I get into this slide, looking at this delta dollars, we've got a huge figure here, 113,000. Now, another way you can look at delta dollars is by working out your potential losses. Okay, so it's not perfect because options and Greeks are dynamic. They kind of change as the market moves. But let's say we've got a position like this leading into tomorrow, and we've got, forget what the market's doing right now or what this position is, but let's say we just had a position that had negative 113,000 delta dollars. If the market bounces and goes up 1%, purely on the delta, we're going to lose about 1% of that 113,000, okay? Now, if the market continues going down, great, we've got negative delta. We make 1% of that for every 1% drop, right? Does that make sense? So, that might be fine for some people. Maybe some people think, yeah, the market's going to drop. I'm happy with this negative delta. I want negative delta. That's fine. But if the market bounces and goes against you, let's say the market bounces 2% tomorrow, you're going to lose 2% of 113,000, maybe more, right? Because it starts to accelerate. It gets exponential and starts to snowball. So really, really, really important. The key is keeping these exposure levels in check, because as I said, it's exponential with these positions. As they start to move against you, the losses get bigger and bigger and bigger, okay? All right, so that was the point on delta dollars I wanted to make. So back to this slide, a concept called layering that I want to share with you guys, okay? Really important concept. It's an advanced technique, but it's called layering. Let's take a look at a condor that's gotten into trouble on the call side. Look at the delta and also the delta theta ratio. So we're, getting up, almost a 1-to-1 delta theta ratio. It's too much of a directional exposure. Okay, so that's a trade that we had put on and it had gone up. Market had moved against us really quickly, under a lot of pressure. Okay, so what could we have done differently? Instead of going into the trade with a full allocation of 10 contracts, this trader could have started with 5 contracts and then added another 5 contracts after the market had moved. While this trade's still under pressure, it's under much less pressure than the initial trade. All right, does that make sense? So, important concept. With condors, instead of going in with the full whack on day one, what's the worst thing that can happen in that situation? The market tanks the next day or has a massive rally, right? So instead of going in with your full whack on day one, maybe you start with a half position size, okay? And then you wait 3 or 4 days or even a week, and then you add the second half, or you could even do 25%. Something I've done really successfully in the past is start with 25% position size. And again, talking about that consistency that we're going to talk about in a minute, just every Monday, I did 25%, 25%, 25%. Did that 4 weeks in a row every Monday, just really mechanical, wasn't trying to predict what the market's going to do, was just really mechanical about it, and it works really well. Okay, so you're kind of moving with the market. As the market goes up, you're moving your strikes up. Next week, the market drops, you put on your strikes a bit lower, and you're moving with the market. So if this trader had done this, instead of having 113,000 delta dollars, he's only got 60,000 delta dollars. Yeah, it's still under a little bit of pressure for sure. That's a pretty high exposure. Delta theta ratio is 44%. It's still reasonably high, but it's much lower than it was on the other position. Okay. So this is what a layered position might look like. Instead of that first graph where we had all our strikes here close to the money, we've now layered it out a little bit and we just move with the market. If the market continues to go up, we'll just add another one further up. Okay. So here you can kind of see graphically how that might work. We start with our initial condor here, the market goes down a little bit, we add here, goes up, we're moving our strikes up. It's kind of like waves on the ocean, right? You're just going up and down. You're just the boat just bobbing up and down with the market and just constantly putting your strikes above and below where the market is at the time and just layering in. Okay, consistency. So one of the keys to success in any field is to develop consistency in thought and actions. If you apply the principle of consistency to your trading, you'll find it has the power to take you to the next level of success that you are seeking with your trading. Consistency is one of the key things I preach to all my students. Decide what your goals are over the next few months and work consistently to achieve them. Do something every day to work towards your goals. So consistency in your actions, also consistency in how you trade, okay? One thing I'd hate to see is you guys are all motivated, you're all keen, to get into this options trading. You start doing it, and then a month or two goes by, you get busy with work, or the kids get sick, or whatever, and you kind of drop off and you lose motivation, and then you get back into it. You've got to be really consistent, okay? Try and set aside time each week to work on your trading, review your trades, work on your trading plans, and just be really consistent about it. So consistency leads to habits. Habits form the actions we take every day, and action leads to success. All right, pretty important. So next concept I want to talk about is liquidity. So slippage and commissions can seriously add up in this game. Thankfully, in the last decade, these have both come down significantly, and it's enabled retail traders to participate in strategies previously only available to banks, hedge funds, and market makers. But still, you need to be smart about it, right? So previously, up until probably 10, 15 years ago, I guess, retail traders just couldn't trade iron condors. Okay, probably about 15 years ago, I guess. You know, the cost to doing so was just so high. The commissions, the bid-ask spreads were really high. You know, now really is a golden age for option trading because of, you know, the technological advancements that we've had, you know, the competition in the broking space, very, very low commissions now, very, very tight bid-ask spreads on a lot of these underlyings. But you still want to be trading things that are really liquid. You don't want to be trading things that, you know, have low open interest and low liquidity, right? So let's take a look at the SPY again. We've got here some calls and puts. You know, we're looking at our 11 delta again on the calls, 10 delta on the puts. Look at the spreads over here on the right. So we've got a bid of 67 cents and an ask of 70. Okay, very, very tight spreads. SPY is the highest liquidity for options, right? So if you're just starting out, you could do worse than just trading SPY. And look at the puts here, 80 to 82. Virtually a non-existent spread, right? You're going to get filled very, very quickly and a very good price on any of these options, right? Okay, you can see that here as well. We've got volume here in this column and open interest. You can see just a huge amount of volume in every single strike here and a huge amount of open interest. Okay, so very, very easy to get fills at good prices. If we compare that to IYT, okay, so it's a transportation ETF, pretty well-known ETF, but look at the volume. There's no volume on some of these strikes. There's zero open interest. You know, the spreads are $3 to $4.70, $1.95 to $4.30, massive spreads. It's going to be very, very hard to get filled on these positions. There's no open interest in these strikes here. Same on the puts, zero open interest. If you're trying to get filled on some of these trades, like the 168 strike, zero open interest. If you do manage to get filled, you're the only person in the whole world who has a position in that option, okay? And if you then need to try and get out of that position, you know, the market makers know you're the only one, right? So they can just set whatever price they like. Okay, so stick with liquid options, stocks, ETFs, you know, all the big name stocks, the Dow stocks, you know, some of the big indexes and ETFs. Okay, don't go trading any crazy little stocks or ETFs, okay? All right, strategy selection. So option trading is all about volatility. Just like stocks, we want to buy low and sell high. So when volatility is low, we want to be long volatility. In other words, we want to own volatility, or also known as long vega. And when volatility is high, we want to be short volatility. In other words, we want to sell volatility, also known as short vega. Okay, we talked about that a little bit last week. We want to look for stocks that have high vol. We want to sell options. We want to look for stocks that have low vol. We want to buy options, right? And same with the market in general. You know, the market and volatility has really spiked up these last few days. Now's a really good time to be starting to look at, you know, building up those short volatility positions. Whereas if you go back a week or two, volatility was really low. You know, that's the time when you want to be adding those long vol positions, which would have done really well the last few days. So in terms of strategy selection, this is kind of how I break up my positions. So 40% into long-term or investing capital. So those are, you know, long-term positions that I want to have in some of the Dow stocks, dividend stocks, positions that I want to hold for a long time, right? So we're talking about things like wheel trades, if you know what a wheel trade is, poor man's covered calls, also known as like a leap diagonal or a long-term diagonal trade. Then 40% into trading capital. So this is where we're doing things like condors, trapdoors, butterflies, credit spreads. Want to have 10% of my account for speculative positions where I might take some directional exposure, do some hedging. So I might, when volatility is really low, might be buying some VXX calls, things like that. Minimum 10% in cash for adjustments and things like that. So that's kind of how I split things up. Obviously, you can do whatever you like, but this is one thing that I sort of find works for me. So, those trades I was talking about: wheels, poor man's covered calls, condors, trapdoors, butterflies over here on the right. Diagonals, weekly butterflies, straddles and strangles about 10%. Okay, so have a think about how you might want to split things up in terms of your trading. And one sort of last concept I want to cover is looking at positions individually, but then also looking at them at a portfolio level. So that concept of portfolio management. So we're going to look at 3 positions. We've got a condor here. Individually, this position's okay. It's got a little bit of negative delta dollars, but it's not too bad. Doesn't really need to be adjusted. Delta theta is about 10%, so still within acceptable levels. So that's okay. We also had a trapdoor at the same time. Also, this one was looking fine in terms of our rules. Delta dollars is pretty low. The actual delta is -2, so basically neutral. That delta theta is really low. Negative delta also, but individually that's fine. And then at the same time, we had a bearish butterfly. So again, individually, this position looks okay. Negative delta dollars, but it's okay for this position. So all our rules individually look okay. Then what we do is we combine everything into one. Okay. So it might look a little confusing because we've got lots and lots of different strikes, but you need to get used to this. We've got 3 individual trades that we've put together, gives us a little graph like this. And also a bit of negative delta. So we've got 3 positions with negative delta. Overall, we've got negative delta. So even though the 3 positions individually are fine, having that negative delta, maybe we want to add a position in a different underlying, or even something in the Russell, like a bull put spread that gives us a little bit of positive delta, maybe gets us a little bit more neutral. Or we might be happy with this exposure. As I said, it's not a huge exposure. Delta theta is pretty good. Everything's not too bad. So we could leave it as is, but you want to be looking at positions individually and also as a portfolio. Chris, that's fairly easy within Trader Workstation. You can just combine them, or it has like a portfolio view as well. Reach out to me after the session if you want some extra help with that, if you've got interactive brokers. All right, so that's it, guys. We got through that pretty quickly because there wasn't really too many questions. So I'm happy to stick around for a little bit if you guys have some questions. I also wanted to share a couple of charts, a couple of stocks I was watching for you guys. So got another little watch list here. So a few stocks that have been making some big extreme moves. Pfizer has had a big decline, so that's one that's on my radar. Rio Tinto is another one that's on the radar. Under Armour has been crushed. ExxonMobil, Molson, so TAP. I like Coors Light, so always follow that one. AMD is another one, pretty badly crushed the last little bit. Nice update today. That's always a good sign when the semis are doing well. Procter & Gamble, this was one I pointed out maybe to you guys last week. I can't remember, that it was pretty overbought. So that's had a bit of a pullback. So that was a good one. Same with Goldman Sachs. That was really overbought. I think IBM and Microsoft maybe were the other ones last week. Intel, another chip stock, that one's on the radar. It has dropped below the 50, which is a little bit of a concern. So I'd really like to see Intel get back above the 50. And obviously Apple's had a pretty big decline as well, back below the 50 for the first time in a while. So that's another one, looking at for sort of long-term bull put spreads. I'm short the 150, 140 bull put spread out to January. So that one's, I've had on for a while, so that's still doing fine. So, you might wonder, how have I done over the last few days with things like this? Yeah, I've had a few losses on some of these positions, but a lot of them are out sort of that 6 months, 3 to 6 months. So they, getting back to that very first slide, they don't get as affected by these big declines. And I've had it on, probably 3 or 4 months. I think I got it on when it was at about 170. So I've had, a couple of months of rally. So I'm still positive on the bull put spread, even though it's, given back a little bit of profit recently. And also what I did when it got up to here at about 210, I was adding the bear call spread. So I turned it into a condor, sold, I think it was either the 240 or it might have been the 250s that I sold, and was long the 260s. So obviously making some money on the bear call spreads on the way down, which helps to offset some of the losses on the bull put spread. So we'll trade on XOM. Brian, don't mind that at all. You may have to be in it for the long term because, oil's been really crushed lately with the whole, global growth story. So that may impact XOM for a little bit longer. But certainly, one of the biggest companies in the world, one of the biggest stocks in the Dow, in the red zone in terms of RSI, so deeply oversold. So there's some value there for sure. Couple of things concerning me, the 50-day moving average is declining. We're getting across the 20 over the 50, so that's a little bit of a concern. But I think eventually it's going to stabilize. It may go a little bit lower, but if you're in it for the long term, and you don't mind taking ownership, if you're selling puts down at 65 or 60, and you're happy to take ownership there, then yeah, absolutely, can't go too wrong. All right, guys, any other questions? A couple of others that had some big declines that I had here. Some real growth stocks, Roku, TWLO, Twilio, Invitae, and Trade Desk. So these are some other stocks that have been really, really strong, and some of them are actually holding up pretty well during this decline. Roku, Invitae, and Trade Desk. Twilio's had a pretty big decline. The volatility's gone through the roof on some of these names, so you can actually sell some puts a long way below the money on these names because they've got high vol. So a couple of other ones that I'm looking at as well. Question from Chris on trade size. So yeah, as I said, so 40% would be for things like condors. So let's say you've got a $100,000 account. Your maximum capital at risk on condors is 40,000. So I might start a position with 10,000, on the Russell and then scale in that way, or I might be, building a portfolio of individual stocks and ETFs where I've got a little bit in the Russell, I've got a bit in Apple, Walmart, XOM, ones like that, right? So it's really just, how many positions do you want to have? And then just making sure it doesn't go above that sort of 40% or 40,000, whatever your account size is, right? Now, in terms of the number of positions, I also don't like to have too many because it just gets a bit unruly and a bit hard to follow and a bit hard to manage. That's what I find. Some people, they want to have 50, 60 positions. For me, that's just too many. I tend to want to have no more than, absolute maximum of about 20 positions that I'm monitoring, right? Because I don't want to be spending all day analyzing things. Okay. And how does Delta Dollars work within that? Yeah, good question, Chris. So, exactly the same. You just add up the Delta Dollars of each individual position. So, maybe you've got positive $10,000 on a Russell Condor, but you've also got a bear call spread on Apple that's negative 3,000 Delta Dollars. So your overall portfolio Delta Dollars is 7,000, right? And you can also, Trader Workstation also has, can convert that Delta Dollars into a beta weighted as well. So, whether that's accurate or not, but if you've got, for example, 2,000 Delta Dollars in a high moving stock like Twilio, might actually be a higher exposure than $2,000 in Pfizer, a low volatility stock. So You can beta weight it as well. I don't worry too much about that, but that's something that you can do as well. Do I trade the bearish butterfly monthly or just opportunistically? I actually just do it opportunistically. I try and look for times when the market's really overbought. So looking at when the Russell gets up to that 70, 80 RSI, and that's when I'll look to enter it. I really don't want to be doing bearish butterflies when it's really oversold, because if the market goes on a 2-3 month rally, it's just going to crush your bearish butterfly, right? So you want to be looking at it only when things are pretty overbought. Cool, no worries, Chris. Good questions, guys. Anything else? All right, well, I hope you enjoyed that, guys. And if you do think of any other questions, feel free to email me. I'll get the replay up for you guys if you want to go through any of that again. And look forward to hearing from you guys soon. Have a great week. Talk to you soon. Thanks, guys.